Here's something that doesn't add up. Two people, same city, same age, same job title, same salary written on their offer letters. By every measurable standard, they should be in the same financial position. But at the end of each month, one of them has money left over. The other one is checking their bank balance 3 days before payday, doing mental math, wondering where it all went. Same income, different outcomes, and the easy explanation is that one of them is bad with money. That one spends too much on things they don't need, that it comes down to discipline, to choices, to personal responsibility. But what if that explanation is incomplete? What if the number on the job offer, the one that says $30 an hour or $62,000 a year, isn't actually the number that matters? What if there's a different number one that never appears on any document that determines whether you end up with money left over or money running out? This isn't a rare occurrence. It's not happening to a few people who made bad decisions. According to recent surveys, over 60% of working adults in developed economies describe themselves as living paycheck to paycheck. And this isn't limited to minimum wage workers. A significant portion of people earning well above the median income report the same experience. Working harder, earning more on paper, but not actually getting ahead. If this were random, if it were just about individual choices, you'd expect it to be scattered, unpredictable. But it's not. It follows a pattern. People across different industries, different income brackets, different lifestyles. Reporting the same disconnect, the money they earn, doesn't seem to translate into the money they keep. And here's what makes this worth examining. It's not that these people don't know how much they make. They know. The number is right there on the pay stub. It's that the number on the pay stub might not mean what they think it means. $30 an hour sounds like $30 an hour. But there's a calculation that most working people have never done, a calculation that reveals what that $30 actually becomes by the time it reaches their life. That's what this is about. There's a concept that exists in personal finance literature, but rarely makes it into mainstream conversation. It's called the real hourly wage. The idea is straightforward in principle. Your real hourly wage is not the number on your contract. It's the amount of money you actually retain divided by the total amount of time you actually spend on your job. That sounds almost too simple to matter. But the reason it matters is that both sides of that equation, the money and the time, are almost always calculated incompletely. Let me walk through how this works. The first adjustment is the one everyone knows about: taxes. Before any paycheck reaches a bank account, a portion goes to federal tax state or regional tax Social Security contributions, Medicare, or equivalent programs. Depending on the income level and location, this can reduce the gross number by anywhere from 15% to 35%. This is the calculation most people stop at. Gross salary minus taxes equals take-home pay. That take-home number becomes the mental anchor for what the job is worth. But this is only the first layer. Every job comes with costs that exist solely because the job exists. These aren't lifestyle choices. They're requirements, direct or indirect, of being employed in that particular role. Transportation is the most obvious. Getting to a workplace requires either a vehicle or public transit. A vehicle means fuel, insurance, maintenance, parking, and depreciation. Public transit means monthly passes, occasional ride shares when the schedule doesn't align. These costs would not exist, or would exist at a much lower level without the job. Then there's appearance. Most work environments have expectations, explicit or implicit, about how employees present themselves. This translates into clothing appropriate for the setting, grooming standards, sometimes specific equipment or accessories. A construction site has different requirements than a law firm, but both have requirements. And meeting those requirements costs money. There's also the infrastructure of working. Depending on the role, this might include a reliable phone, a laptop, a home internet connection sufficient for remote work, software subscriptions, professional memberships, continuing education to stay current. None of these expenses show up on a pay stub, but they're directly tied to having the job. If the job disappeared, these costs would reduce or disappear with it. Here's where it gets less obvious. When a job claims a certain number of hours each day, it's not just claiming those hours. It's also claiming the energy and availability that would have existed during those hours. The result is that tasks which could have been done personally now get outsourced not by choice, but by constraint. Preparing meals takes time and energy. When both are depleted, the alternative is food, prepared by someone else at a markup. Cleaning maintenance errands, childcare, pet care, these all have self-service options that cost less and outsourced options that cost more. The job doesn't mandate outsourcing these things, but it creates the conditions where outsourcing becomes the path of least resistance. This is what might be called the substitution cost. Money spent to buy back capacity that the job consumed. I notice this in my own patterns, actually. The busier the work period, the more likely I am to pay someone else to handle things I would otherwise handle myself. It feels like a choice, but the choice is shaped by a constraint I didn't fully choose. There's another category that's even harder to see because it disguises itself as reward. Work, especially work that involves stress, monotony, or emotional labor, creates a deficit of energy, of patience, of mental bandwidth. And deficits create demand for restoration. This restoration takes many forms: entertainment subscriptions to decompress, drinks or meals out to mark the end of a difficult stretch, purchases that provide a sense of compensation for effort expended, vacations framed as escape, services aimed at reducing the physical or psychological toll of sustained effort. The pattern is consistent. Energy goes out to the job. Money comes back in from the job, and then a portion of that money goes back out to repair what the job depleted. This spending doesn't feel like a job expense. It feels like personal choice lifestyle, sometimes even indulgence. But there's a question worth asking. How much of this spending would exist if the depletion didn't exist first? I find myself wondering this more often lately. Which of my own expenditures are genuine preferences, and which are responses to a deficit I didn't consciously sign up for? So far, this has been about money. But the equation has two sides. Real hourly wage equals money divided by time. And just as the money is usually overestimated, the time is usually underestimated. The official work week might be 40 hours. But that number only counts the hours spent at the designated workplace doing designated tasks. It doesn't count the time spent preparing to be presentable for work. It doesn't count the commute time that can't be spent sleeping, or with family, or on personal projects. It doesn't count the lunch break that technically isn't work, but also isn't freedom, because the location and schedule are still dictated by the employer. It doesn't count the time spent thinking about work after leaving, the email checked at dinner, the problem mulled over before sleep, the mental presence of the job even in its physical absence. And it doesn't count the recovery time, the period after returning home where productivity is essentially zero because the capacity for anything beyond passive consumption has been exhausted. When all of this gets added up, a 40-hour job often becomes a 50-hour commitment, sometimes more. So, the real hourly wage formula looks like this income. After taxes, operating costs, substitution costs, recovery costs, divided by contracted hours plus commute plus preparation plus recovery time. The numerator shrinks, the denominator expands, and the resulting number, the real hourly wage, is different from the one on the offer letter, sometimes slightly different, sometimes dramatically different. This is the mechanism, not a conspiracy, not a scam in the criminal sense, just a math problem that most people have never been prompted to complete. To see how this mechanism plays out, it helps to run the same situation through two different lenses. Someone earns a gross salary of $62,400 per year. That breaks down to roughly $30 per hour, based on a standard 40-hour work week. After federal, state, and payroll taxes, assuming a moderate tax burden, the take-home might land around $48,000 annually. Divided by those same 2,080 work hours, that's approximately $23 per hour. This is where most calculations end. Gross to net. The number feels concrete. It becomes the reference point for every financial decision that follows. Same person, same salary, but now the other variables enter the equation. Transportation to and from work costs money. Clothing and grooming appropriate for the workplace cost money. The meals purchased because time and energy for preparation weren't available cost money. The services hired to cover tasks that would otherwise be self-managed cost money. The spending that follows a demanding stretch, whatever form that takes, costs money. These amounts vary depending on the job, the location, the industry. But they're rarely zero. If these work-dependent expenses total $12,000 over the course of a year, the net amount retained drops from $48,000 to $36,000. Now the time side. The official workweek is 40 hours, but the morning routine that exists specifically because of work adds time. The commute adds time. The lunch hour that isn't free time adds time. The decompression period after returning home adds time. If the true weekly commitment is closer to 55 hours instead of 40, the annual total rises from 2,080 hours to roughly 2,860 hours. Now the division. $36,000 divided by 2,860 hours equals approximately $12.60 per hour. Same job, same offer letter. But through one lens, the hourly rate is $23. Through the other, it's $12.60. This becomes more pronounced when comparing different positions. Consider two hypothetical roles. Job A offers $75,000 per year. It's in a downtown office requiring a 45-minute commute each way, professional attire, and a high-pressure environment with frequent overtime expectations. Job B offers $55,000 per year. It's located 10 minutes from home, has a casual dress code, and rarely extends beyond standard hours. On paper, Job A pays $20,000 more. The conventional logic suggests Job A is the better financial choice. But when the full calculation is applied, when transportation costs, wardrobe requirements, time expenditure, and recovery spending are factored in, the gap narrows. In some configurations, it disappears. In others, it inverts. This isn't to say Job A is worse. It's to say the comparison changes depending on which variables are included. The same logic applies to upward movement within a role. A promotion typically comes with increased compensation. This is presented as a straightforward gain, more money for the same person. But promotions also tend to come with expanded expectations. More hours. More visibility, which can mean higher appearance costs. More responsibility, which can mean more mental carryover outside of work. More stress, which can mean more recovery spending. If the raise is 15%, but the associated costs rise by 20%, and the time commitment rises by 25%. The real hourly wage after the promotion could be lower than it was before. This doesn't mean promotions are traps. It means the calculation that presents them as purely additive might be missing terms. I've seen this dynamic described in different contexts, people who moved up and felt like they were somehow moving backward. The math might explain why. Not always, but sometimes. The point of these comparisons isn't to reach a verdict on what any particular job or raise is worth. The point is that two different methods of calculation can produce two very different answers from the same inputs. And if decisions are being based on only one of those methods, the other set of answers remains invisible. There's an assumption embedded in how most people evaluate work. The assumption is that income means the money received. But in any other context, business investment trade income means the money retained after costs. A company that earns $1 million and spends $1 million has zero profit regardless of revenue. Yet with personal labor, the tendency is to look only at the revenue line. There's a second assumption about time. That work time equals hours on the clock. But if a job claims not just presence, but also preparation, transit and recovery, then the denominator in the hourly equation is larger than it appears. These aren't errors in judgment. They're defaults, how the information is typically presented, how the comparisons are usually framed. The question shifts when the framing shifts. Instead of, what do I earn? The question becomes, what do I retain per hour of life committed? Instead of which job pays more, the question becomes, which job leaves more behind after its own costs are subtracted? This doesn't change any external circumstance. It changes what's being measured. And what gets measured tends to shape what gets noticed. $30 an hour on a contract might be $30 an hour in reality. It might be $20. It might be $12. The number depends on variables that don't appear on any offer letter or pay stub. This isn't a flaw in the system to be outraged about. It's not a secret being kept from anyone. It's simply a calculation that exists but isn't commonly performed. The gap between the stated hourly rate and the real hourly rate isn't fixed. It varies by job, by industry, by geography, by individual circumstance. Two people with identical salaries can have very different real wages. The same person in two different roles can experience very different returns on their time. What that means for any particular situation isn't something a video can determine. That calculation belongs to the person living the situation. This channel exists to examine the questions that sit beneath the obvious ones, the math that runs quietly under the surface of work, money, and time. If this particular question opened something worth examining further, there will be other angles to explore. Thanks for watching.